in like 2020 or so, we were selling a lot of our assets, 70s, 80s, early 90s vintage assets for above replacement cost. And as much as I would like to think I'm God's gift to earth, nobody is going to be able to sell 30, 40, 50-year-old product at above replacement cost. I mean, this makes no sense at all. So we took a lot of those acquisition monies that we made, crushed it on, and we took it to developments in the Midwest where we have a cost advantage. That has saved us big time. Now, you can call it good fortune, good luck, intelligence, timing. I mean, it's a confluence of these events. But being diversified, not just in one strategy, across multiple strategies, across multiple markets, across different years. I mean, we're doing the same work, guys. We're doing multifamily, but
Yeah.
it's different markets, different times, different types of product. That's really saved us, basically.
You're listening to the Real Returns podcast, where we learn how real investments can make a real impact. Join your hosts, Andrew and Dan, as they share stories and interview business leaders on how real estate and other forms of investment can create meaningful change for individuals and communities around the world.
Hey everyone, welcome back to another episode of the Real Returns podcast. I'm your host, Andrew Reichert, and we are entering into season 7, where we're interviewing interesting founders who are doing interesting things with their company. And before we get into our guest for today, I want to introduce my co-host, Dan Croce. Dan, what's happening over there today?
Man, I'm dragging today. I stayed up too late, past my bedtime, watching the Steelers lose last night. And, you know, with all this CTE stuff going on and football is like a really bad thing. Playing American football is like one of the worst things you can do for your brain. And I heard recently that the only thing worse you can do for your brain than play American football is stay up too late watching other people on your couch play American football and doing so unsuccessfully. So I got that out of my system. I'm doing all right. I'm back in the saddle. And I'm excited for today's show. So Omar Khan's going to be a great guest.
Yeah, really excited. Omar Khan is a founder and managing partner at Boardwalk Wealth. They're similar to us, our main operating company. They do apartment acquisitions. They do development. They've actually done so for over 800 million of transactions and about 5,000 units, really all across the Sunbelt and the Midwest. So I really like Omar's kind of fundamentals first approach to multifamily investing. He's got really a commitment to executing with precision and consistency. So excited to have him on the show. Omar, thanks for being on the show. To get things started, why don't you just tell the listeners just a little bit about yourself, kind of your background?
Yeah, look, before I get started, I'd like to tell you, Dan, look, you got all the bad parts of CD, but none of the good parts doing what you did, right? With none of being on the field, having a good time, being a superstar. So, man, you got the short end of the stick both ways, man.
Yeah.
So I feel bad for you, is what I'm trying to say. But don't worry, I live in Dallas. We're used to misery. So you know all about that. And before that, I used to live in Toronto, which is another town that knows a lot of sporting misery. So, you know, I understand where you're coming from.
Man, you guys got the Raptors. They won the NBA championship not too long ago. But
Dude,
we've had our fair share of stuff to cheer about in Pittsburgh over the years. But I'm past the age where I should be staying up late watching other people run around on a field.
Especially if you're getting CD. Look, I mean, similar to you guys, we do apartment acquisitions. We've done developments as well. I don't know if you guys do that. And lately, a lot of our business, because we've got a great management team here as well, but I'm blessed to have great colleagues and partners. We've also done, in the last about 16 months or so, we've taken over close to 1,800 units from distress indicators, lower to middle market sponsors. This is primarily as a result of our relationships with lenders, but also borrowers, by the way. Lenders want us to step in because we've got a great management platform, a track record of success. As Andrew mentioned, we've done close to 800 million in transactions. I mean, full cycle deals, 26.6% IRR, 2x equity multiple, all of that stuff. But in the last year, we've taken over 1,800 units from borrowers and lenders like that want us to step in, you know, rectify operations, do all of that stuff, and then really turn the ship around. And hopefully, you know, the Fed cooperates and rates go down in the next year or so. So that's that. I wish I could tell you cooler stuff than that. I mean, I'm a CFA charter holder. Not very cool.
No,
I'm a dad. I don't have as good jokes as Dan did there. But
hey, why don't you walk us through the genesis of the business? How did you find your way into the real estate world? I see that you are a CFA. That's a journey that I started once upon a time. And then when I realized how hard it was, I was like, I'm not going to pursue that thing anymore. But how did you get into the real estate business? Tell us about the genesis of the company.
Well, I mean, look, the CFA part was just because I was out of college and it was just what a lot of other people were doing. Toronto's a finance town. So if you want to get into portfolio management or any of that sort of stuff, you sort of kind of have to do CFA if you want to be on the institutional side. So I'm lucky I got it out of the way at an earlier age in life, because during the exams I would see people that were say, they had a real life. I was single, young at the time. They had kids. The one lady I know, I think she was due like a week after the CFA exam. I was like, how the hell are you even doing this stuff? Right? How is this even possible? So I got it out of my system early. But the genesis of this business was my family's an entrepreneurial family. Unfortunately, they weren't rich like Bill Gates. Otherwise, we'd be really balling over here. But, I always had that bug in me, and I did investment banking, portfolio management, corporate development, advised on a couple of $1 billion of capital financing and M&A transactions. But then I met my wife, 12, 13 years ago. She was finishing up her residency in upstate New York. I was in Calgary at the time in the oil and gas patch. And I was like, yeah, that's right. I'll move to the U.S. How hard can it be? Right? I mean, 300 million people live here. they obviously aren't a country that's sparsely populated. So I moved down here, and, American entrepreneurialism, American exceptionalism was the thing. But what I always tell people is the real genesis is I lived in the Socialist Republic of Canada, and anybody can tell you the first time they make any modicum of money, the gross number looks really good. You're like, yes, this is awesome. Then you see the number that hits your bank account, and it's 51% or less. And you're like, okay, I hate this shit. I need to make money, but I need to save on taxes. So that was a real big genesis. When you're in investment banking, portfolio management, you get these big paychecks, but so much of that is taxed away that if you just run a simple calculation, you realize, the solution to everything in life is just not to keep running faster on the hamster wheel. So that was the real genesis. And apart from that, I enjoyed the real estate aspect because I was running and putting deals together on the investment banking side. It's a very relationship-oriented business, so I understood the capital markets and investment sales side. And luckily for me, I had great operational experiences just because of the mentors I had over the years. But again, every business is new. You just start, one door opens up, you've got to go through that door, then another few open up, and then you learn along the way. And I was very lucky, number one, that I have great colleagues, great partners, but I always tell people I could be 1,000x more intelligent and 1,000,000x more hardworking. But if I wasn't in the great state of Texas, if I wasn't in America, none of this would have happened. We wouldn't even be close to any of this stuff happening.
So tell us about like some of the first deals you did. Did you start investing in Texas or?
Oh, no. Because I know a lot of people say, I bought a house and I did all of that stuff. But for me, I was like 30-ish when I started, 30, 31 when I started my business. And look, luckily for us, between my wife and I, we had good corporate careers. Like, she's a doctor, so I don't know if that's a corporate career, but a good career. I had a good career. And I was like, look, if I start buying these houses thing, I will need to be like 500 years old before anything ever materially starts happening, and I can even try to escape the rat race. So my first transaction was 138 units in Jacksonville, Florida. I lived in Dallas. That was one of the markets I had outlined alongside Dallas. I got on the plane, met a lot of people, got that deal awarded. This was about like 8-10 years ago. And then it was a mad scramble to do a lot of things, as you guys know, right? Arrange the financing, get the equity raised. And it was I don't know how all of that happened. I wish I could tell you the formula, but it was a lot of sleepless nights. It was just squeaking past the finish line, but it was also a great deal. So that really helped. But I also think living in Texas was a real big boon because, again, I don't have much experience about other states, but Texas is so entrepreneurial. You meet people for coffee, you meet people for lunch or dinner, and they see potential in you and they want to back you. Right? That's something that you don't get to see in a lot of places because I've traveled extensively around the world. You don't really get to see that pace and quickness of action. So I was very lucky that way. Look, I could have done everything correctly, but if I didn't live in the great state of Texas, I didn't have this sort of an entrepreneurial environment around me that rewarded this type of action. This stuff wouldn't have happened. We went full cycle on that deal within about 2.5 years. Investors made a boatload of money on that deal. And that's really how my ship left the harbor.
Wow. Okay. And was the vision initially to build a company? When you did that first deal, was it, hey, I know I want to do this at some scale. I want to, actually build a company and a team, or was it, hey, let's do a deal and see what happens? Or when did the vision for Boardwalk really start to come into reality?
Well, look, there wasn't like there still isn't some overarching grand vision of I have to be the Grand Wizard of Oz of like multifamily or something, but it was clear basically. And again, you got to understand, I was like 11 years into my career at that time, right? So the vision was there in the sense that yeah, we this needs to be a real company. You need to hire people as you go. You need to reinvest in the company. But the real vision there was we need to constantly do opportunistic deals and kind of put ourselves in positions where the odds are tilted in our favor. Or as I tell my team, we need to bring a gun to a knife fight. Basically, we want unfair competition and we want to be opportunistic. So that vision was always there. But as you go along, as you grow, as you reinvest back in your business, as markets go up, as markets go down, you refine your processes along the way. But I was very lucky that we were very clear about the culture that I wanted to build or the types of people that I resonated with. And I was very lucky that so far, at least, the partners I've had, the employees I've had, the other people, stakeholders I've had, they're aligned with that vision. And sometimes what happens is I've had partners that said one thing but did another, but none of them were dishonest. So I give my partners a lot of credit that I'm lucky to have them in my life.
Sure.
Omar, I'd like to take a step back. You had mentioned the tax benefits, part of what drew you to, kind of thinking of yourself as, having the opportunity in the US, benefiting from some of the tax laws here in the US versus Canada. I know today tax efficiency is something that's a big part of your investment thesis. It's a big part of what we talk about here at Burgo. I mean, real estate is just such a tax advantaged investment program. Can you just talk a little bit about the tax side of what you do?
Yeah, look, the tax side, look, everybody, there's for conventional down the fairway deals, I think it's table stakes now, where you have to run bonus depreciation, cost aggregations, all of that stuff. That's table stakes. But where we've been able to add some juice, especially in the last little while, we have a portfolio, by the way, out in the market, where we've really able to add juice is that when we are taking over these deals, where we are taking over from troubled syndicators that are distressed, either by going directly to the lender or the borrower invites us to basically come in and rectify the ship. Because we structure these deals, there's a couple of levers you have to pull there. What essentially happens is we have anywhere from like, God, if we need to say $4 million for a transaction, we have $8 or $10 million of depreciation. So depending on the transaction, we can offer a dollar for dollar all the way to $2 or $3 for every dollar of investment. Now, every deal is different, but that's where I feel the real juice is added, because if you're going to talk, just say bonus depreciation, cost segregation, that any self-respecting, semi-sophisticated sponsor is now doing. They weren't doing that 5-7 years ago, but they're doing that. And especially with the one big beautiful bill, bonus depreciation coming back, I do feel if you got to go right now, because you never know when laws change.
Yeah, makes sense.
Omar, talk to us about, we tend to, on our podcast, have an orientation towards impact, thinking about the stakeholders and, the holistic outcome of our entrepreneurial activity. So talk to us about who do you think about? Is it, the investors, the tenants, the employees? Who are the stakeholders that you're thinking about when you wake up in the morning, and what is the impact that you're hoping to have on them through the work you're doing?
I have a fiduciary responsibility to my investors first. So everybody is wired differently, right? And everybody has, while we want to ensure that we provide safe, stable communities that are nice, high quality product, because at the end of the day, if our residents aren't happy, then they'll leave the property. Then we'll have turnover. Then we'll have all these other costs. And then effectively at the end of the day, we will make less money. And I've always been very upfront from day one. This is a for-profit business and a for-profit exercise. I do not run a charity. So my first duty is to my investors as a fiduciary. But here's the thing. I feel when people say this stuff, this is just my opinion, I feel like people say that there is some sort of an hierarchy or ordered ranking. And I don't think that's the right way of looking at it, because as an example, if you just say, I want to only look out for my investors, as an example, right? Those are my biggest stakeholders. Well, the problem there is you can only look out for your investors 99% of the times if you are taking care of your residents, if you are taking care of your employees. Because, for instance, you could have a great resident base. But if you don't have top quality management, you have constant turnover of staff, your staff is not happy with you, they're not trained properly, they will not be able to provide the right service to your residents, right? And I'm very careful with the word residents versus tenants. Tenancy applies some sort of a power dynamic in the relationship. Residency applies a shared outlook and vision. So we're very particular with this verbiage. So while my stakeholders primarily and my duty is towards my investors, I don't feel there one has to have an ordered hierarchy here because these things holistically have to go together. If you don't have great demographics that pay you on time, or you don't respect your residents, then they won't pay you on time. If they don't pay you on time, your business will not be able to run. You'll probably have some sort of an effect on your employees. If that happens, you have constant turnover. This then has an effect on your investors because you cannot maximize returns for them. So instead of a hierarchy, I feel it's sort of like a circle where or it's like a three-legged stool. All three legs of the stool have to be there. Otherwise, if one of the legs is missing, then the stool falls down. And then nobody wins.
Yeah, that's great. I think we're really aligned and share that perspective that it's impossible to just pick one stakeholder to optimize for. There is an ecosystem, and we're all in this together in a very real sense. So I appreciate that. Can you talk to us? So my understanding about the way that you've built your firm is that you've had a pretty ruthless focus on fundamentals, and you continue to be very fundamental focused. So talk to us about what that means for you. What are the fundamentals that you care about, and kind of what are the first principles, origins of the way that you think about doing the business that you do?
Well, look, first of all, I think it's an ever-evolving process because like any serial acquirer or developer, we made our mistakes as well in the last upcycle. Now, I feel my pain the most. But when I talk to other operators, I realize, wow, either we dodged a lot of bullets or it didn't fit in our buy box and we never stretched to do that stuff. So even though we made mistakes, these are salvageable mistakes. So with regards to fundamentals, the way we look at it is, like I said earlier, you want to be in an unfair fight. You want to bring a gun to a knife fight. The reason is, this is why we want to be in supply-starved markets where either through NIMBYism or through other legal or other mechanism, new supply coming to the market is always going to be less while there is adequate demand for just quality affordable housing. Now, typically, not always, this ends up being that you need to have good schools and good hospitals and good social amenities within your community. It's not always the case, but typically that's what it ends up being. So your school rating out of 10 gotta be at least 7 or 8, right? Somewhere 6, 7, 8, somewhere in that region, higher is better. Then if you've got a quality hospital, it doesn't have to be like border your property, but it's just within the wider submarket. That's usually a sign of good attractive jobs. And lastly, what you need ideally is a lot of NIMBYism, not in my backyard. So you know that when you buy something, there's not an avalanche of supply hitting you. Now, in the Sunbelt where we are, that last part is a little hard to do because, look, if you look in Dallas, there is no geographical constraint to its growth. If you look at a place like Orlando, there's really no geographical constraint. Even Atlanta, I mean, you can grow in all directions for as long as you like. So you got to pick these pockets very carefully. But that's what we believe in hindsight because we believe, look, a supply and demand one-on-one is always going to be the case. Whether it's in real estate, you're selling cars, you're selling chocolates. When you have more demand but no or less supply in the market, by definition, your valuation and your pricing is going to go up. Now, that being said, another underappreciated element over here is a lot of real estate, like a lot of life, is timing. You could have done everything wrong and be in the market in 2012. You could have been a complete idiot and been in the market in 2012, and you would have made money. And you could be walking on water. And if you bought in 2021 or 2022, in most major markets, you're underwater. So all of that being said, just realize that I'm fully cognizant that, like a lot of life, real estate is timing. But yeah, I mean, you want to tilt the odds in your favor, but they'll never be 100%.
Yeah, I think that's a great point there. And just thinking about that a little bit further, there's only so much that you can control. So it sounds like what I'm hearing from you is focus on the fundamentals, control what you can control. That sets you up best for generating the best returns and do what you can, I'm guessing, to hedge against the inevitable, cycles that kind of happen to all of us. Has that sort of been your approach?
Yeah, look, and the other thing also is I feel don't ever get too concentrated by buying too much in one year or one time. It's like dollar cost averaging. Just as you are, investors will invest, sponsors should also do this. What's really saved us, I'll give you as an example, in this down cycle is that in early part, like 2020 or so, we were selling a lot of our assets, 70s, 80s, early 90s vintage assets for above replacement cost. And as much as I would like to think I'm God's gift to earth, nobody is going to be able to sell 30, 40, 50-year-old product at above replacement cost. I mean, this makes no sense at all. So we took a lot of those acquisition monies that we made, crushed it on, and we took it to developments in the Midwest where we have a cost advantage. That has saved us big time. Now, you can call it good fortune, good luck, intelligence, timing. I mean, it's a confluence of these events. But being diversified, not just in one strategy, across multiple strategies, across multiple markets, across different years. I mean, we're doing the same work, guys. We're doing multifamily, but
Yeah.
it's different markets, different times, different types of product. That's really saved us, basically.
Well, I love your point of thinking of it as dollar cost averaging.
Yeah.
As long as you're in the game every year acquiring real estate, you can sort of weather some of those ups and downs. And really, you get the blended return of decades and decades of real estate exposure, which has always proven to be good. So rather than trying to time the market, you get, you kind of get the stable, consistent returns. So I think that's a great point. We're going to jump into the lightning round. And I feel like the listeners have gotten to know you a little bit professionally, want to just get to know you a little bit on the personal side. So first of all, what would you say is your biggest win?
Oh, my biggest win is so far having a great family, but that's not really a win. That's more luck and accident from time to time. But I'm going to call it a win right now. Right. And especially, look, I'll say this, especially as I'm growing older, we're at a stage in life where I'm in that in-between stage. My parents are old, right? So hopefully they don't die soon. they're in a very different stage in life. And we are in a stage, we're in the in-between stage where we have a cohort of people that are younger than us. And just the other day, I was talking to somebody and they were going to college and talking about finance. And I was like, oh, shit, it's been like over 15, 17 years since I graduated. I mean, you don't even realize it, right? And I was looking at the person being like, dude, aren't you too young to be going to college? And then I realized, no, that person's not too young. I'm too freaking old. They are the right age to be going to college. So we're in that in-between stage. So I think a lot of this realization is hitting us now more, or at least me more, than it would be 5, 7, 10 years ago.
Yeah, it's so true. How about favorite movie?
Favorite movie, Casablanca, American Psycho, Life is Beautiful. Those are really good movies. Yeah. But I used to watch a lot of movies. Now I got young kids, so I'm not really that hard on the movies right now.
Yeah. How about a favorite food?
Oh, favorite food. How long do you have, man? I love eating food. So steak, we have a stool called nahari. It is slow cooked over 12 hours, all beef, obviously, right? Love that. I'm basically a big sucker for Texas barbecue as well. I think I'm not willing to go or argue with somebody, especially when they say they're going to put sauces and stuff on their barbecue. I'm like, man, your meat must be really shitty.
So true. So true. How about a current growth edge? What's the way that you're trying to grow personally or professionally?
I think learning to be more patient. That is not a strong suit of mine.
That's a lifelong journey.
Yeah, I don't know if I'm going to succeed in that, or I don't even know if I'm actually doing something, but I like to tell myself I'm doing something in that regard. Let's put it that way.
Yeah, makes sense. How about some good A+ content that you're taking in these days? Books, podcasts, anything like that?
Oh man, I used to listen to a lot of podcasts when I was driving a lot, but now I'm not doing that. I got a shelf on back, man. I mean, I love reading about real estate guys. There's a lot of guys, the Reichert family. Hold on, let me find out. There must be something over here. Yeah, there's one book called, hold on. So where is the Reichert family book? I'll show it to you. Where is it, man? Now that you need to find it, you can find it. Jesus, man. Okay, there's one more point.
Dan's going to tell another dad joke if you take any longer.
Oh, Dan, I don't think I can take it. Oh, yeah. This is a really good book. So Towers of Debt. So because I used to live in Canada, so I knew about the Reichert family. They were at one time the richest family in the world, not just Canada, right? This is basic. Oh, you guys have to read this because this is a family that went from nothing to the richest family in the world, and then had, well, by their accounts, a collapse. By our accounts, they're still billionaires, so they're doing fine, right? But just the tale of basically how sometimes you have to swing for the fences, but really, what gets you from poverty to success is not the same set of attributes that keeps you successful.
Yeah. That's really good. I really learned a ton from this session. If folks want to connect with you, how can they connect with you? Are you on LinkedIn, or what's the easiest way to find you?
Oh, yeah. Well, that's pretty easy. You can go to our website, boardwalkwealth.com. That's again, it's .com. You can join my mailing list. The form's right on the homepage.
Great. Well, Omar Khan, thanks so much for being on the show. It was great to hear a little bit about kind of your background and your founder's journey from starting, really with that first investment all the way to where you've gotten today with 5,000 units. I learned a ton. It was really cool to also just hear about how you think of impact and being a fiduciary to your investors. And so thanks for being on the show. Listeners, thanks for listening in, and we'll catch you all next time.
Thank you. Thank you, guys.
Thank you for joining us for this episode of the Real Returns Podcast. We hope that you learned something new about how you can invest to make a lasting impact on those around you. Please be sure to subscribe to our show wherever you listen to your podcasts, leave us a review, and share about us on social media. We hope you will join us for our next episode, where we will be continuing the conversation around impactful real estate investing.